You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
No discussions in the podcast are meant as an offer to sell or a solicitation for an offer to buy any security. All investments should be done after careful review and consideration of the investment documents and disclosures. Contents discussed in the podcast are not meant to be construed as an investment, tax, or legal advice. Individuals should always consult his or her own professional advisors before any investment decision.
Hey everybody, great podcast episode coming up with Aleksey Chernobelskiy. Aleksey has a great newsletter targeting limited partnership investors with a lot of great content on the limited partner investment industry. We have a wide-ranging conversation about just risks for investing in limited partnership deals, things to look for, opportunities. We just tell some stories about really the good, the bad, and the ugly of investing. So it's a great episode. I would encourage you all to take a listen.
Yeah, absolutely. And then on the value add side as well, are those comps the real comps? Is it, if they're expecting a $300 increase from a renovated unit, is that still feasible? I mean, that's where I've tended to focus a lot on, because that's at least something that we should be able to have more control over, regardless of what happens macroeconomically. And do we agree with those rent bumps? Are they already getting it on units in the building, or are they using a complex down the street? And is it really apples to apples?
Exactly. I wrote an article recently called, I think it was called, "We Renovated, but They Didn't Come," or something along those lines. It's kind of a play on words, but the point was that I think there's sort of this misconception from the golden days, which is anytime I renovate an apartment, I'll be able to generate additional income. And I think that's generally true, right? But in markets where rent is dropping, that's not as true, right? And to your point, you have to be very careful to understand, especially sometimes I look at deals where the rates that you're signing at on existing units that are not renovated are very similar to the ones that are renovated. And, perhaps there you can argue the seller is just stupid and they have no idea what they're doing. But sometimes it's not really the case. Once you start to look at comps, you realize that there's just not much of a spread to be made on these renovations.
Yeah, and during the run-up in 2021, 2022, there were some operators that just were realizing they could get almost the same rent without renovating, and they actually put some renovations on hold, and we're getting close. We're getting 2/3 of the rent bump without having to do the renovation. So I think sometimes people did it because it was a standard playbook, but you didn't really have to do it. I've also seen people try to kind of out renovate the rate moves and got themselves in bigger trouble because they took occupancy down too low, trying to just renovate as many units as possible, and then they got stuck with a higher vacancy and not being able to meet some covenants. So it's a double-edged sword on the value add.
Yeah, it's tough to execute those business plans, but I think for an LP that you just have to know what the plan is and don't be afraid to ask questions.
Exactly. So we've talked a lot about multi. What are the top other asset classes that you like or that you cover and focus on?
I've advised on all. I think all. Office, industrial. I've done hospitality stuff, and I've also sort of have had several engagements outside of real estate as well. Venture capital, oil and gas, all types of other stuff like small business buyouts, stuff like that.
Interesting. So yeah, on the real estate front, other than multifamily, what are your favored one or two others? If you're going to tell a potential LP to spend some time digging into another sector or two, other than multi, what are your top one or two favorites?
I think I wouldn't I wouldn't think of it as I think there is plenty of opportunities across all asset classes. And what I would urge them to do is focus more on who is around me, let's say, that I can get to know and form a relationship with that's very real, and has experience, right? And if that happens to be an industrial, okay, so look into industrial. You take your first industrial deal, you pick it apart, and you learn. Meaning, I wouldn't necessarily go asset class down. I would go like, who's in my city, for example, in terms of syndicators. Who can I relate to based on like some simple Googling, looking around, right? And what types of deals do they do? Yeah, I see deals every week that are industrial deals that make sense. I see industrial outdoor storage that makes sense. RV parks, multifamily. Like there's great deals to be had across all industries. The more important thing, and I think this is something I talk about a lot, is the property itself, in my opinion, is first of all only one of three pillars for LPs to consider when investing. And in my opinion, it's kind of like the least important too, which is kind of strange to say. In other words, like your relationship with the GP, the alignment of interest, the GP's history and ability to execute, all of those things are more important than the actual property. They're all important together, right? But there's a reason why I put property third.
Yeah, that's very, very true. I often, tell people that personal relationship is probably the best way to start. I got started because when I was working in New York City, I would go to the local real estate club, and there was another guy who kind of had the same story as me that started with a bunch of single family, two family, realized it wasn't scalable. Mm-hmm. And I followed him for probably 5 years because I wasn't as liquid at the time when I, was sort of building up my net worth. And then, totally. 5 years I saw him doing deals, and eventually, I started investing as an LP myself while I was still working full time in a private equity job in New York. And it's a great way to, between podcasts like this, your newsletter and your content, local clubs, there's plenty of conferences where you can meet both tons of operators and also just other people that are actively investing on the LP side. Very rarely are we doing a deal with somebody who just comes off the street and cold emails me. It's largely any deal that I've gotten involved with is either through a mastermind group I'm in, or where it's one of my investors or a friend or someone I know is actively successfully invested with the group.
Right. Yeah, I think relationships are super important. And that while we're on this topic, you should also not get jaded by relationships in a sense, because I think what some LPs do is, they meet someone who is like nice to them and smiles, and they're like, oh, I would love to invest in your deal. And they do no diligence because the person was nice and they seem trustworthy. And and then they call me 3 years later with issues. How could this be? They were so nice. I thought I could trust them. And, Jack, in some cases, the problem kind of lies with the LP in some cases, This is a tough world because I think there's responsibilities that sit with both sides of the transaction. And, it's easy to blame the other side when something goes wrong. But I think the reality is sort of the responsibilities are really sitting with both parties.
Yeah. That actually reminded me of another statement where, there's a lot of, say, doctors now that start their own fund and they're like, hey, I'm a doctor, other doctors invest with me. And one of my friends from business school goes, the last thing I want to do is give my money to another doctor to invest. That's kind of a double-edged sword. Sometimes, you have an affinity, you have some shared experience, but it doesn't necessarily mean that just because somebody has a, similar background that they should just be, the only person or the automatic person you trust to invest with.
Yep. I talk about that all the time. And some people don't like it. I mean, I have a whole article on what I call feeder funds. And I think there's a place where feeder funds there's a reason why they exist, and I think there's a place where they provide a ton of value. But I think from the perspective of an LP, if there's an intermediary, you have to understand, how do they get compensated? How could they alignment of interest be different with you versus how they get compensated by the GP, right? Like, could there be something off, even though they're sort of like in between you guys? You have to be a little bit skeptical, I think, and I think that's actually healthy. I usually say, what's the word? I'll find it. I can't remember. I have like a phrase to describe this, but the point is like, you're optimistic, but also you have sort of like the skeptical nature about how you think about investments.
Yeah, the whole feeder fund thing, that could be a deep dive type of conversation in the future, because it's a pretty big part of my business model. And it's something I always, we're in business to make money, but we're very conscious of not double feeing our investors and trying to create win-wins. So that's a constant battle to try to negotiate better terms so that it's a win-win for everybody. And but it's certainly a challenge as well, because sometimes GPs don't want to give up as much. You also don't want the GP to make so little that they don't have enough upside 100%. To be motivated as well.
100%. And I think it just starts with understanding how everyone in the transaction gets compensated. It's so basic, Jack, but I think many times people transact without understanding that. And they just sort of assume something, and then they realize that that assumption was wrong when it's already too late. But by the way, what I was referring to is healthy dose of skepticism. That's what I referred to it as. And the point being is, like, there's an unhealthy dose too. Like, you can put all your cash under the pillow and never invest it. Happens to be right now is not the worst time to do that with 5% rates. It's not such a terrible worst case. But also, I think there's sort of like a healthy amount of like skepticism and due diligence, and then at some point you sort of have to be like, okay, like, I think I did my work. Would I be okay if I lose this money? Right? How much can I allocate realistically? And then you sort of go in and you start learning.
Absolutely. So I followed you on various social media, and I know you also, I believe, have a Substack. But if you can, for me in the audience, kind of give me the rundown of really your business model and what services and what where all your content is and how people can work with you. Sure,
Jack. So as you pronounced, my name is pretty unique. So you can find me on LinkedIn and Twitter. I try to write there daily, although the past week or so has been a little slow. Outside of that, people can always get a hold of me at Aleksey, Aleksey, at hey.com, which is hey.com. And in terms of my writing, the Substack that you mentioned, I write twice a week to getting close to 5,000 investors at this point. And that's lplessons.co, which is CO, lplessons.co. And, people can sign up. They can, I have a bunch of, at this point, I think close to 100 articles on a bunch of different topics. I write weekly. I send digests every week on sort of topics that came up during the week that are interesting for people to read and get familiar.
Great. And you also have some private Zooms as well, right? Like kind of deep dive on deal type things, or?
So I don't invest on behalf of LPs at all, but I do various like training things. I call it like the LP cohort. I also recently started a seminar, which is more like deep dives on capital calls and things like that. It's essentially meant for people to get better at vetting transactions, responding to like capital calls, how to analyze stuff.
Yeah, it's super helpful. And, I'm in over 50 deals. So I've had unfortunately a few capital calls, myself, and,
they happen,
not immune to some of what's happened in the market. Luckily I'm in a lot of fixed rate deals that are kind of humming along great, but, I kick myself because I, went into variable rate debt deals thinking that a 3-year interest rate cap would be enough. And, in some cases it certainly wasn't. So, even somebody, I think I'm a pretty good picker. I do this professionally, but not foolproof myself either. So,
I think what's interesting is I was actually just speaking to some LPs the other day. No, I think, Jack, most people would have assumed that a 3-year rate cap would have been fine. And if you're sitting in like June of 2021, I think that would have been a reasonable assumption, right? Meaning you sort of have a model. Now, I do wonder what percentage of GPs actually did this, right? What I'm about to describe. Because I think if you didn't, that's it's not great. Okay, but what I'm about to describe is what I think hopefully some GPs did, and I think there you sort of there's a point at which you just you can't predict everything, right? And so, like, for example, if a GP is sitting in June of 2021 and they're like, look, I'm going to get 3% debt, I'm going to get a 3% rate, a 3-year rate cap, and this is my plan within 3 years. And if by year 3 interest rates go up by 200 basis points, I can still get all my money back, to investors. Meaning even then, with that and rate and cap rates moving up, I can still get my money out for the LPs. They don't lose anything. So like that, from a sensitivity table perspective, is actually like pretty solid, right? Like you're sitting there in June of 2021. And you're like, well, at some point rates have to go up, but like surely it won't be what just happened, right? Like, you could have asked the best economists in the world. You can look at sort of what the predictions were coming out of the economists, and like no one knew, right? But my point is, as a GP and as an LP, if you're going into a floating deal, you better have a sensitivity table. And I think not to have one is almost negligent. Right, like it's like one of the biggest catalysts of your deal where things can go wrong, and hopefully you had some wiggle room that was reasonable. And as I said, I kind of wonder like how many GPs did that exercise, circle like 2021.
Yeah, it's something that, for me coming from, and I've never been like an Excel guru myself, but I did put in 10 years in distressed debt in New York. I kind of backed in after the financial crisis. So, to me, it's just like, it's just a level of sophistication. If you can't have that financial, and frankly, in multifamily, the models, there's a million templates for models. So if there's not a level of sophistication to provide it, it actually is a big red flag for me, just because I'm used to seeing, just being surrounded by so many Wall Street people that have, have that ability. So, if it's a couple people that just went to a seminar and are trying to club up and do a deal and, either can't do it yourself or hire someone for, $1,000 or $2 to, do an extra level analysis and put together, it's a major red flag.
Yeah. So I'm careful with the word red flag. I wouldn't call that a red flag. In fact, I would tell you, in many cases, I've seen deals that don't have great models be better than deals that have great models. That's not a rule. I'm just saying I've seen counter examples each way, right? And what you really want, Jack, at the end of the day, is you want a GP who's experienced and knows what they're doing. And some of those people might not be great at Excel, right? And so what sometimes happens, and I see this all the time, like sometimes a GP that doesn't really know what they're doing hires someone to put together a model and puts that model in front of the LPs. And I think in some sense that's worse, because like you're basically sending something to LPs that you don't like maybe fully understand. You didn't really put it together. You haven't done this business model before, but Jack, like, that data table looks beautiful, right?
Yeah.
And like the formatting is amazing, right? And that's my point. Like, it's like these things are so subtle, which is why I'm like so careful with using like red flags and all this stuff. It's like it's
yeah. And as you're talking, I'm kind of correcting myself in a way as well, because you just reminded me that I've actually used the analogy sometimes where we like a really good operator that's a bad marketer. There are some of our better partners just don't, they just want to be at the property executing, and they're, not the schmoozer, not the guy who wants to, go out and ask for money. So that those become some of our better partners too. So,
right. At the same time, within like just a quick like counter example to that is like the business is run on fundraising, and typically the best deals, generally speaking, anything that's brokered at least, or shown off market is shown to people that are the most active. How do you become the most active? You have like a massive pipeline of equity. How do you have the most pipeline of equity? You're probably marketing. You know what I'm saying? So it's like these things, as an LP, you just have to understand that these things live together. I hear you, and I understand the perspective of like, I would rather someone that's like, not on the socials and, taking TikTok videos and whatever. And I think there's some truth to that, but you also have to be like sophisticated and I guess worldly enough, let's call it, to understand that there's like pretty solid counter examples to these things too.
Oh, 100%. Yeah. Very little is black and white. There's so many gray areas. There's very few absolutes in this business. I think it's just important to digest as much information as possible from trusted sources. And, you're one of my trusted sources. I really appreciate the content you put out, the well thought out content. And, I know, you've got a hard stop here. So I wanted to thank you so much for coming on the show. We'll put in the show notes a link to your social media as well as your Substack, and hopefully we can do this again sometime. I really appreciate the conversation.
Yeah, this was awesome. Thanks again for taking the time, and I'm looking forward to continue the conversation.
Thank you very much.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.